Welcome back friends. Today we are going to discuss about investment planning, the main and vital part in personal financial planning. So far we have seen how to prepare monthly budget based on the inflows and outflows, various expenses and how to streamline the same, and optimize the investable surplus. Now let's understand how we can plan and put in the same effectively and maximize returns to create the wealth. Friends, this video is bit lengthier to cover the investment basics. Kindly watch this till end, and while investing, please follow the 4 rules mentioned at the end. These 4 rules are very important, though these seems basics. Trust me, implementing these 4 principles will definitely help you in shaping up your wealthy future. Now let's start with understanding various investment avenues and risks associated with the same. This is very important before proceeding for investments. You have to choose the products suitable to you based on your requirements and goals, considering your risk appetite. So, let's first understand what is this risk appetite. Friends, risk appetite means your capacity to bear the inherent risks of these different financial products. Now, your risk bearing capacity depends on various factors, like your financial position, family background, nature of your job or business, and also your psychology. So, all these things matter when you are checking on your risk bearing capacity. Say for example, if you are only wage earner in the family of 4 members, your capacity to bear risk will be lower compared with the person having 2 wage earners in the family. Again, it depends on the income also. In case the income is higher with multiple income streams in the family, will obviously uplift your risk bearing capacity. Take another example, where you are not financially strong enough to take high risks, but psychologically strong enough and willful to invest in products associated with high risks. Here you have to stay away from your emotions and sentiments and think rationally while investing. Because money matters, and investing as per your requirements considering your risk appetite will fetch your appropriate returns. In a nutshell, it is advisable to avoid such high-risk products when your risk-bearing capacity is low. No matter, you will feel you lost better earning opportunity, but you have to analyze the risk associated with and go ahead based on your capabilities to bear that risk. Similarly, when your financials are strong, and you are capable of bearing high risks, you should not shy away from such products. At such times you have to take calculated risk for optimizing your returns. So friends, you have to decide your investment path after considering all these factors affecting your risk-bearing capacity and not merely thinking based on your psychological factor. Now let's discuss about various investment avenues available in the financial markets. The investment horizon is huge and very much widespread. There are several financial products and lot more are introduced every now and then. We shall discuss the mainframe avenues and products here today. Traditionally, people used to put in their savings in fixed deposits of various banks, where they used to get fixed rate of interest. That means the funds are provided as debt or loan for earning the interest. Predominantly the fixed deposits are kept with banks, may it be public sector, or private sector, or even cooperative banks, then non-banking finance companies, popularly known as NBFCs, or certain other companies, then cooperative credit societies, etc. All of them accept fixed deposits from investors. Usually, the bank interest rates are lower compared to NBFCs, where the risk associated is higher. Even several other companies also offer higher rate of interest to lure the investors. But please note, higher the rate of interest, higher will be the risk. In a nutshell, risks and returns have direct relation. Higher the risk, higher the returns and vice versa. Now friends, apart from fixed deposits, banks and some of the others also offer recurring deposit facility to the investors, wherein they invest certain monthly installments and at the end of the term, bank provide entire amount along with interest. However, these are all debt-oriented instruments, where the interest rates are usually lower. In case where the rates are higher, then that's because of credit risk associated with such products. For example, some of the manufacturing companies may provide higher interest rate. But all depends of their business module, and factually your fixed deposit amount will be at risk as they may not be able to discharge their interest or principal repayment obligation in case their business suffers. Hence, you have to check the company financials, its management, current market conditions for such company, etc. before investing. Further, there are some other fixed interest rate instruments in the market. For example, post office deposits and national savings certificates, PPF, National Pension Scheme, which is popularly known as NPS, etc. All these investments are specifically considered as tax-saving avenues. Though there are certain limits and typical conditions attached to these products, you may consider these for investing from tax savings perspective. However, you need to judge suitability of these products while investing. Then there are some debt-oriented mutual fund products also in the market. We will discuss about them in more details when we discuss about mutual fund investments. So far we discussed about debt-oriented investment avenues. Now, let's discuss and understand about the other part, that is equity-oriented investment avenues. Equities means investments in such products which are directly or indirectly linked to share capital of the companies, and as such you become the owner to the extent of shares you buy. But, please note, investments in equities and equity-oriented products bear high risks. Let's discuss first about direct equities, which predominantly pertains to secondary markets. That means buying and selling of equity shares of various companies on the stock exchanges through the registered stockbrokers. Nowadays, due to digitization, transacting in secondary market has become easier compared to earlier days. Several brokers provide facilities to transact online. Even some of the private banks have started operations of brokerage houses through their subsidiaries, and under one roof, you get all the facilities. But, for buying equity shares, you have to do the thorough analysis, that means fundamental as well as technical analysis of various companies. You should have in-depth understanding about the businesses and broadly about the industry as well. The fundamental analysis consists of detailed study of the company, its working, its management, its financials, etc. etc. Also, the peer companies analysis and industry analysis also form part of this. The second part, that is technical analysis, is the study of price movement in the past as well as various patterns expressed on charts. These charts assess the price changes and identify the buying opportunities by estimating future movement of the prices. So usually in stock markets, the stock selection is done on the basis of fundamental analysis, and the time to invest in that particular stock is determined with the help of technical analysis. Several brokerage houses, banks and other financial institutions in the market do the required in-depth analysis and assist investors in their decision making. However, if you wish to invest in direct equities, I mean stocks, it is necessary to know the basics of stock market investing and shall have complete understanding of functioning of various companies. The key benefit of investing in equities is to get the higher returns through capital appreciation as well as the dividends by purchasing and holding high-yield dividend-paying companies. However, the main drawback of direct equities investment is the requirement of larger capital, I mean big corpus fund required. Also, you should be able to pull out the time to study and do the analysis required for this investing. Friends, please note that the pains taken for the study and analysis for investing in stock markets will fetch higher risk-adjusted returns surely. With proper understanding of stock markets, you can think of building a strong portfolio of equities. Friends, so far we have discussed about transacting in secondary market, I mean stock market. However, there is one more way and that's primary market, known as IPO, that is initial public offer. Here, the companies come up for the first time with public offering. You can apply and get the shares in such IPOs. If you are wishful of creating equity portfolio, you may evaluate good offers and grab the deals to acquire these shares. Similar to IPOs, there are FPOs also. FPOs means follow on public offers and the style of investing will be almost similar to IPOs. Now, let's discuss about investing in mutual funds. In case you find it difficult or troublesome to go with direct equities investments, mutual fund is the right option. Mutual funds are governed by SEBI and there is complete transparency in the functioning also. Mutual funds provide various disciplined and systematic ways of investing. Further, in contrast to direct equities, you can invest small amount in mutual fund and have better diversification to optimize the risk-adjusted returns. So friends, mutual funds are another big and wide spectrum available for investments. There are a lot of mutual funds and several schemes floating around in the market. However, in mutual funds also you need to understand various schemes available in the market and their features. Complete study is required to find out the schemes which will suit your requirements. There are predominantly two types of schemes, that is debt and equity. Debt schemes usually invests in fixed income instruments like bonds, government securities, etc. and earn interest income for the investors. Whereas equity schemes invest in equities and generate income in two ways, that is appreciation in prices of equities and the dividend income on these equities. Usually, debt-oriented investments are preferred as safer and conservative style of investing especially for short term. Whereas equity-oriented investments are chosen for fetching higher returns considering the risks associated with. However, optimized returns to beat the inflation in the economy can be expected from equity-oriented investments. Lastly, for this video, please follow the 4 rules as you begin investing. That is, number 1, educate yourself before investing. Number 2, do not invest blindly, based on tips or rumors. Instead, sell on rumors. Number 3, never let your emotions drive you. Number 4, always diversify your investments and do not put entire funds in a single place. Friends, so far so good. We have discussed about different avenues available for investments. However, considering the size of this video, I have not discussed these various avenues in complete details. But surely I will discuss about each one of these avenues separately in my upcoming videos. Hope you liked this video and found useful. If so, please do give me a like, which will encourage me to do more such videos. Please do share the same with your friends and relatives and do subscribe my channel, if you like the same. Friends, in the next video, we will discuss about estate planning, which is very important and yet another ignored area. We take lot of efforts to create wealth, and it is equally important to plan and ensure that the same moves in the hands of your loved ones, that is your heirs. In the estate planning, we will discuss about safe and systematic transformation of your wealth to next generation. Thank you and bye for now, till we meet again in the next video.